If you have questions, feel free to fire away. This is the Commercial Real Estate Podcast. This is the Commercial Real Estate course for commercial real estate professionals called the CRE Pro course. And we're answering questions live today. Right now, we're going to dive into the Austin, Texas market. If you are looking to sell, buy, trade, lease, leverage, dive into the commercial real estate market in Austin, Texas, I'm going to go through exactly what's happening, who is buying, selling, what's available, and then we're going to go through some questions from our good friend Chat GPT to find out what is happening in today's commercial real estate market. So with that, let's just dive in. I'm going to add the CoStar report for the commercial real estate market in Austin, Texas. If you have CoStar and you want to follow along, please feel free to do so. If you don't, and you'd like to learn more about commercial real estate in the Austin market, feel free to fire away any questions that you may have. I'm going to dive into exactly what's happening inside of the market today, and then where we're looking at in terms of office, for example. So I'm going to zoom in here so you can see this a little bit better. So as we look at the key KPIs for the commercial market in Austin, we're going to look at a few different metrics, and those would be the sale metrics. So I sell investment sales properties here in Austin, Texas, and the surrounding MSA, so the market service area. So if you have questions about the Austin market, Central Texas, this is a great place for you. If you have questions about other markets, fire away on those as well. Happy to answer any of those questions. We'll just jump into one of them here. So if we're talking about, so we've got a question about triple net properties. In particular, how is triple net doing in the Austin market right now? Good question. So what a triple net investment is where the tenant actually is paying for a majority of all of the expenses. Now, every lease is negotiable. Every lease can be modified, but in particular, we're talking about a commercial real estate triple net lease. We can look here at what's happening in the Austin market for properties for triple net leases. These tend to be bond grade investments, and by what I mean by bond grade investments, I mean that the chance of default is very low, and the involvement by the owner or ownership is very, very small. In fact, it's one of the best investments because you have limited to no liability in terms of making sure that the taxes and insurance and the utilities are paid, but you are collecting that rent every month on those properties. So these are things like Walmart or Walgreens, Rite Aid, their QSR fast food restaurants, their tire shops. Think about all of the franchise brands that you're used to. You drive down the street and you see all these brands. Well, they're not in the business of owning real estate. They're in the operations business. So most fast food restaurants or chains are going to focus on the operations, and they're going to offlay all of the resources for real estate onto an owner. That could be you. So if we look here, let's look at the Austin market, and we can look at let's look at retail, for example. This will give you a really good example of what it looks like, what the Austin market looks like in terms of properties available, why I like or don't like specific assets. But when we're talking about the triple net aspect of property, it's a really great opportunity for a long-term hold and for passive income. You're not going to see the violent swings that you might see in a development property, for example, but it also requires a lot less investment in your time and a lot less investment in worrying, frustration, and so on, as long as you have it leased up. So let's see here. Let's jump in. Let's take a quick look again at this. Just want to make sure that we're running on all channels here. Looks like we are. Cool. So you can see all the gray dots there. All the gray dots are properties that are existing but are not currently for sale. The blue ones are those that are for sale, or for lease. Now we'll just dive into directly what is for lease, and we could take a look at a few of these. On the right hand side, you're going to see all of the different buildings, and then what they are being sold for. Let's just take a quick look at this one here. All right, so we can see again, it's a taqueria. Everybody loves taqueria. In Austin, we pride ourselves on tacos, and particularly breakfast tacos. So there is a difference. If you have worked in or you have experience with the let's see, make sure the channel. Oh yeah, it's clear. Cool. If you have experience in triple net properties, you have any questions, or you're thinking about getting into a triple net property, this is a great opportunity for you to ask questions. If we're looking at the analysis here, and this is what I do on a daily basis, I want to run through all of the different asset classes that I work in particular commercial, industrial, warehouse, distribution. I love those asset classes right now because there is a huge move towards last mile distribution. You see Amazon is scaling back quite heavily on their floor space across the country. During the pandemic, obviously expanded, and we were doing a lot of online ordering, and Amazon really benefited from that. When we started to come out of the pandemic, and it's great to hear that yesterday we're now officially out of it, because of that, you're still going to have retailers. People are still going to buy, even in a tough market. I believe that people are now essentially addicted to buying. So, Roger Dog. So we do see that the retail has continued to increase. We've got office scaling back, and but as Munger says, right, you always want to buy when there's blood in the water. You want to buy when nobody else is. So if you're sort of the contrarian, maybe office is a great opportunity right now. I am bearish on QSRs, fast food restaurants like this. Even if we've got a triple net at $46, it seems a little bit high to me. But again, this is as an investor, this is what's coming into your pocket. This is on a per annum basis, so it's $46. Trusty HP calculator here. We're talking about $46 times, what do we got? 2452. So $112,000 for this property coming in per annum, and we divide it by 12. You've got $9,300 coming into your pocket every month. You have little to no overhead and expenses. The tenant is paying all of these. Now, every lease can be negotiated, but as you see, we have a triple net lease here, the rent at $46. It looks like it is not leased right now. Well, let's see here. First floor, and okay, El Pastor, the taqueria, and then it looks like we have some additional space in here. They're leasing this section. Okay. So we can do a lease analysis here. Let's see what this comes up with. Lease proposal, lease not identified. Let's see what we got here. So here is a comp property that they're showing us for a similar property, tenant not disclosed, 2756, year one cash flow, $1,200 or $12,000, $1,000 a month. We just saw that this total NOI, so not a great investment here in my analysis. If we're talking about the other one, which is $46 triple net, we're talking about $9,000 a month, and this one's $1,000 a month. Now, of course, it really will depend on what is happening with the long-term lease of this property, and then who the tenant is. So let's take a look here. Let's go back and let's look at a few of the other things. So investment or owner user, we can see the last sold price, $703, and they're asking $770. So this building is for sale 1.89 million. If we talk about 1.89 million, and we're talking about how you would fund that today, we're looking at market rate for commercial loans at the prime plus 1.5. So if we're talking about, let's just consider that this is in retail, we're looking at an 8.5% loan. You can get commercial loan. We'll talk about 75% loan to value. So the loan to value is well, let's just say in this case it was a $1.89 million, and the buyer would have to come in with 25% of that in cash. So 1.89 million, 25% of that, $472,000. So if you're going to buy this building, you come in with $472,000. You can get a loan for the additional amount. So 1.45 million on a loan. We're looking at let's see this here. So the balance of this would be 189,000. Let's just say you're going to pay list price. Now, again, remember, investors, a list price is just a suggestion on both sides. It could sell for more, it could sell for less. The sale price is what the buyer and the seller agree to exchange this property for money. That's really what it comes down to. We're going through a market correction right now, which means that there is a differentiation in the bid-ask spread. So bid-ask spread, the ask would be 1.89 million, and let's just say in this case you thought that this property, based on the potential or the current market and what you have to borrow money at, let's say you could only borrow $1 million. So your $1 million plus the quarter that you need to bring in cash will be, let's just say 1.35 million. So you would make an offer for 1.35 million, and there would be a financing contingency on it. The property needs to appraise. The bank needs to take this to loan committee in most cases and pass it through. So those are all things to think about. Also, days on market, the amount of time that this property has spent being actively sold is down here somewhere. And when we start talking about all those things together, along with what you realistically think it should be sold for, it's kind of looks like yeah. I'm very familiar with this property, and it's traded a bunch and gone through a bunch of different owners. And so this makes me a little bit nervous. This property right here, they did a good job of cleaning it up. I think this is the new skin that they put on it. That was just recently. So let's get back into the math, though. We have 1.89 million, and we're going to borrow 75% of that. So it's a 1.063 million that you're borrowing, and you're going to be borrowing that at change of sign. So you're going to be borrowing that at 0.0, let's say 85 to be conservative. So you're going to have a payment of $90,000 a year, and if you're talking about monthly, talking about let's see, 90,000. $90,000. Yeah, we're talking about. So you're paying $7,200 in debt service. And if we were looking at what they thought they could get, and this is maybe just a pro forma at $46 triple net, again, that's $9,000 a month. You're making $2,000 a month on this, but you're taking all the risk. So if it does go vacant, you've got vacancy loss in there. So, in most cases, you need a pretty big spread between the bid ask, or between what you're willing to offer and what you're able to make on it. It just also depends on if you've got a tenant lined up, if there's somebody already in it. This is a good example. if you're buying a retail center here and it's vacant, good location, but there's only so many uses for something like this. Well, I guess we see it used to be anytime or a 24-hour fitness. So you could have another fitness store in here. You could have, I don't know, laser tag or something, but or in most cases a retail center, a retail shop. When you have something like this and it's got this parking, it's got a good location, we can see the VPD is probably pretty high, right? So all of these things. Yeah. Booming Austin, Texas. So what do you think that they're going to propose? Love the aerials on this. Very well done. I can't remember who does these videos like this, but we use something called the Oval Room. They do a little bit better. Really well done video. Pylon sign. Signage is very important, obviously. Man, top-notch video, guys. We have 3D walkthrough. That's pretty cool. Wow. Very cool. So I guess unless you're another gym, I just don't know what you would use this space for. Maybe if it has a swimming pool, hoops. Let's see here. Training. Let's see if it has a pool. I think a lot of these don't have a swimming pool, which is kind of a bummer. First and second floor. So, look, they're doing $20 a square foot triple net. Let's see if they have a pool. I don't think this one has a pool, from what I remember. Good space. No pool, but that's okay. Maybe actually an asset. And in this case, there's not disclosing the price, but the interesting thing is that, so when we start talking about how you would price things, regardless of what they're listing it for, if they are proposing that the lease rate is $20 triple net per square foot for up to 35,000 square feet, chances are that somebody that is leasing or somebody that is buying this for owner occupant is going to be thinking about, or leasing it, is going to be thinking about using the whole building. Splitting this building in half, it just seems like a very difficult tenant improvement finish. So let's again go through that math. $20 a square foot times the 35.5. 35.5 and then 35,500 times the $20 a square foot. You're looking at $710,000 on a triple net per annum. We're talking about $59,000 a month. Remember, it's always has to do with how expensive the money is. So in this case, let's see how close they come. Let's see how close they come if we're talking about a $20 a month, a $20 square foot. Roger. Doing crazy, man. Hey, buddy. All right. Let's go outside. Okay. Let's get back into this here. See how this live is doing. All right, here we go. Let's get back into this. All right. All right. So we're looking at CoStar here again. So we're doing the numbers, right? So we're doing the numbers on buying this, what used to be a 24-hour fitness. Now I know that they went through a really tough time during the pandemic, shut down a bunch of stores, and now we're at this sort of spill out of did people go back to the gym? From what I understand, they did, but now their usage is a little bit different. So if they're not going to these big box gyms anymore, there might be a few more of these on sale. And so it's good to know what the numbers are, who the use cases are, who else might be interested in using this. Um, it's not particularly well set up for retail conversion. In other words, you can't put a dock high door very easily on this property. And the ceiling height is not applicable. So really, we're narrowing down the uses need to either be retail. I don't think it'll be another gym. Maybe a specific training facility, and they divide that up into a few sections. Maybe turn this into office, but office isn't doing particularly well right now. So this could be condominiumized with a. Let's take a look there again. Entryway right here. You could have a reception desk up front, and then you could divide them up into smaller offices. It's obviously in a very highly trafficked. I can't have you eat this stuff. Can't have Roger eating the cord. It's obviously in a very good retail location. I really still believe that retail is going to continue, but it's going to be more. It's going to be changed a little bit more. QSR fast food, very tough in today's market, and in Austin we really benefit a lot from the lack of minimum wage, or like the depressed amount of minimum wage, because I was seeing in California and in Washington, New York, minimum wage is like $15-17 or something, pretty crazy. So when you start talking about how do you build that in, because you have to pay all your employees now, do you like decrease the amount of employees, or do you increase the number of robots, the kiosk machines? I know the big highly contested thing recently is whether we tip if we're using the kiosk machines, because then really what service did the business provide? I can think about it on both sides. If you have run a business before, you want to you want the customers to pay for your employees, and if you're an employee, I guess you don't really care where the money's coming from, as long as it's comparable. And as a customer, I want the business to pay. So I pay the business pays their employees. I shouldn't be paying their employees. So that's the way I think about that anyways. I don't know if it's popular opinion or not, but probably not. All right. So as we're going through the math of this one, remember we've got $60,000 a month coming in from this. If it's rented out at $20 a square foot, you're renting all 35,000 square feet. So on a loan like this, though, we can reverse out the cap rate. So the cap rate is the NOI divided by the sale price, and that equals the cap rate. So we know at this point that most investors, for a building like this, to take the risk that they need to lease it up, are going to need to project they call it like a pro forma cap rate of somewhere like 9, 8, 9, 10%, something like that. So if we think about that, and we look at $710,000 a year, this property probably lists at somewhere like $6 or $7 million. Or I shouldn't say list there. It's where I would feel comfortable offering at a 10 cap rate, right? So you're looking at $710,000 divided by $7 million. You're looking at 10%. That's 10 cap rate. That's what it would return to your investors. Maybe if we go a little bit lower than that, $8-9 million, something like that. let's see what they estimate, right? So the rent is pretty on. Taxes we looking at what they're going to pay on top of that. So the investor or the user is going to have to pay taxes, insurance, and utilities. So their number for the rent is going to be higher than $20 a square foot. But that's not your concern as an owner or buyer. You can see the last time it was sold at 9.85 million. So I think we're pretty spot on this one. I think that math is pretty easy to do. In this case, if I were to talk to 2001 Lloyd Putter, I would make an offer on this property at somewhere around $7 million today. If I had a user lined up, that's where I would think about it. So I'm trying to help my clients on a daily basis change their mind a little bit on how they're approaching looking at real estate, because ultimately it depends on what the return on your investment is. And if you can get a 6, 7, let's just say a 5 or 6% return on a pretty solid investment, like a Vanguard index or something like that, I would say, or a bond or something. I would say that for the risk, you don't want to take the risk of buying this building if you don't know it could be leased up. So that's where I would come in on this. Again, let's take a look though. I think this will be really exciting for you guys, right? Bum, bum, bum. Excitement. This is what I do all day. So this is what I look at right here. I look at the industrial space. Let's look at industrial, and let's look at industrial North Austin. So what do we have that is available today in North Austin? Let me point out a few things to you. So Taylor, Texas, right here. Taylor is where the new Samsung plant is going up, and it's going vertical right now. Hornsby Bend here. Let's just see if it's the aerial. So you can see Tesla right here. This is Tesla. So Garden Valley, Green Grove. Look at all this green space around here. This is where Elon's going to put his new, I don't know what he's building, village. All this space really great. They're trying to do an airport. Jim Collins is trying to do an airport out here called the Greenport. If you want to know any more about these things, let me know. So Taylor, again, they just announced this last week. They're going to build the city of Taylor, along with the government, is going to build a large industrial park, apparently. So that's cool. These are some. Let's take a look at this. I love this listing, or any of these really, but this is brand new. This is being constructed. I need to remember who's doing it. Oh, the Aquila guys, I guess, are selling it. I'm not sure who's building it though. We're looking at 17,000 to 51,000. There's really not a lot of information on the leases here. You can see because the market has changed so quickly in this area. Let's see if they mention here in their marketing what they think that the lease rate is going to be. I mean, beautiful park, right? These guys have it pretty well laid out. Applied Materials, Samsung, the domain, Tesla, and then you can see Applied Materials and Samsung factory here. This is the first of 9, by the way, that they're building. Pretty cool. The projected price of it went from $17 billion to $25 billion because of inflation. Pretty crazy. They're still moving forward with it. That's good. And it's the first of 9. So, this area is really going to change quite a bit. I guess I should have flipped over the screen, but sorry about that. Okay, so let's do this. Let's go back here and look at what else is happening in the Taylor market in terms of industrial. Maybe we go industrial flex. So flex warehouse space is stuff that not even really great in that. So really struggling on the industrial flex. Here's what this says to me though. If you wanted to build, so the Samsung factory is down here where this guy's got his land. $3 million. And they're asking, let's see if he has anything planned for it yet. No, it's just a piece of land. And they're asking $1,000 a square foot, $3 million for 37 acres. Looks like they're looking for somebody to come in here and build on this stuff. I like the area. I think there's a great opportunity in this area. Looks like some of it might be in a lake. Let's see. We can look at one of the things I look at here is the maps. So let's look at this. So here's what we do. So I'm going to switch over these screens here so you can see this. I'm going to add on another one here. Present. No, let's pull it up here. So I use a program called MapRight. MapRight is a program that is has the most complete set of data I think that I know of. And it is I used to see people use this and they send it to me all the time, and then now I use it all the time. So I guess that's how things work. Taylor, Texas, we're looking at 600 County Line Road, and let me show you what this map looks like. So, hey, Roger, go. Hey, out, go. Causing trouble. I have a 1.5-year-old puppy named Roger. I don't know how many of you guys know Roger, but Roger's pretty awesome, except for when he's a terror. I'll bring him on the next show. How about that? Okay, so what I wanted to show you is what it looks like on this land, not Landglide, but on the mapping software. Let's see. Let's switch over this here and add a screen. Present. Stop screen, and then we'll present, and we'll add another one here. Share screen. Here we go. Here we go. Okay, cool. So now you guys should be able to see this one. Make sure. Yes, we're good. Okay, so this is what's this thing called? MapRight. So big fan of MapRight. Let's take a look at this property. So I like this one for development, and let me show you where things are here. So this is Taylor, Texas. Population about 19,000 people. They project the let's turn on the parcels on. They project the population is going to triple in size in the next 10 years. That's pretty amazing. About 60,000 people. It's going to. So if you could imagine, this is the population now. You can see where the outline of the city is, and we'll let's see here. Let's look at some overlays here. Overlays are the best part about this software. So let's see. Turn all overlays on. Pretty cool. Look at all this stuff. So pretty amazing. So I like to go ahead and turn the layers on and then turn them off one at a time to see like what really matters. Airports. The airport is Taylor Municipal Airport. They're increasing the size of Taylor Municipal Airport. The runway is going to be now 5,000 feet long. Means that you can land your G6, your G5. I mean, from what I understand, you can land your jet there, i.e. the Samsung guys can land their jets there. Let's pull out the airport. So abstracts, let's turn that off. City limits, let's leave that on. Contour lines, let's turn that off. County lines, don't really care. Energy, okay, turn this off. So good. We're getting a better understanding of what we're looking at here. All right. So again, remember we're looking at this residence or this location here. Here it is. Remember, it's 37 acres. And what I wanted to look at here is how much of it is in the floodplain. So turn off housing developments, FSA. What's FSA? Oh, these are the lot lines. FEMA and LOMAR's FEMA floodplain. Boom. So that matters. If you're on this corner right here and your majority of your property is underwater or is, struggling from flood zone loss, which is all this stuff right here, it's going to be really hard for you. This is a lake. it's going to be really hard for you to build on that area. So even though it looks like it's a pretty good area, it ends up not being so much. It looks like it is in the town, or actually maybe not. Let's turn off the, so that's in an op zone. So opportunity zone, you can see the pink, actually, you can see here is where the city is, city limits. Carves out all this stuff. The op zone is good if you're looking for op zone investment. But if you're just a normal business, if you're just developing land and you don't want to go after the opportunity zone money, it's not really relevant. I've got extensive experience in opportunity zones, and I can tell you that if my golden rule in it is if it doesn't make sense as a normal investment compared to other investments, being in an opportunity zone won't do anything for you. If it's a bad investment, it's a bad investment, whether you're using op zone money or whether you're using private equity money or whether you're borrowing the money. So that's the rule. Make good investments, do good by your investors, and always protect investor money or your own money, whoever you're investing, or the bank's money. So yeah, we've got a lot of good information here. They're changing the zoning here in Texas and Taylor, so I'm not really akin to what's happening in the zoning in this area. But I do like Samsung, and just to reiterate back that this guy or whoever, this group has a good acreage of land, but a lot of it's in the flood zone and it's abutting a lake. So maybe a residential development. I don't know. That would be my suggestion. Let's zoom back out again here. We'll flip back off of LandGlide, or not LandGlide, MapRight, and let's get back into. Make sure this is still going. Yeah, cool. Let's get back into doing some analysis of some of these other industrial opportunities that we were talking about. Let's go present and share screen, and let's get back into CoStar. Cool. Okay. So back on CoStar, and we're looking again at industrial area, industrial land in North Austin around the Samsung factory, or really anywhere in the north. Hutto, fantastic area, overbuilt a little bit, but and I really like it. Let's look at here. So under contract, let's see what this building may have gone under contract for. The best way to do this, obviously, is call the broker and find out. So they're asking $35 million for this tract of land. That's pretty crazy. I wonder what 100 acres. You got frontage on both sides. That's pretty cool. You got frontage all along 130. You've got a highway access here. That's pretty cool. I really like this property. I don't know if I like it for $35 million, but what are we looking at? Let's see here. Price per square foot kind of throws me off when we're talking about land. And they're going to doze this house, I'm sure. You can see it's just a structure. 2,500 square foot bulldozing project, I guess what I would call it. Okay, so if we're assuming they went under contract at approximately what they were looking for, let's see, $35 million, and what was it? 92 acres, 92.7 acres, $377,000 an acre. That's crazy. That's crazy money, because the way that it depends on what your buildable is, what the intended use is. But if you just think about this in a development frame of mind, if you're going to double your money, let's say, if you're going to develop this, and I think that should be kind of double or triple your money, so it should be sort of your exit after 2-3 years. You're going to have to charge $500,000 per acre. So if you're doing that, and let's just say you're building a warehouse or something, If you want to build, and they have something called impervious coverage. So what impervious coverage means is that you can't build on the entire acreage. You have to put some things in for, or account for some things like roads or parking lot or green space. And all these things need to go through, and I'm guessing this is in the city. We can find that out, but they're going to have to go through the city council and be approved for this stuff, and have the utilities. It looks, I'm sure there's utilities. Look at how many houses there are here. That's pretty crazy. So again, Hutto, I like. I'm way more positive on Manor, but look, Manor is going to struggle for this. So what do we got? Yeah, so new proposed. This may be the new. Let's see who. Let's see what we would pay for this, guys. Or let's see if we can determine that. A lot of times it comes down to, let's see here, completely. They're building. Colliers is building it. So what they're doing, this looks like to be spec to me. They're doing overhead, or let's see what they're doing. Yeah, just let's see how many square feet we think we can put on this thing. I like the rendering. So this is net rentable, 135,000 square feet. It's on 10 acres. It's going to be built next year. They're doing floor plates between 36,000 and the entire building, and not disclosing the sale price. So again, chances are you just jump on the phone and call any of these guys. Pretty reputable people. Okay. So this is what I like to see as well. This is going to really help you if you're thinking about investing in the Hutto market. I have a analysis here, and I'll go through some of these numbers, what they mean, and then what we're thinking about. So this is really great to know. Again, you're backing into all of these all of these purchase decisions. So at this point, these are triple net rates per annum. So we're talking about $1.10 a square foot for this market. So let's just pretty quick math, right? $135,000, $135,927. We'll multiply that times, let's just say, let's be positive in this, 12.75 to $12.75 triple net per year. We're talking about 1.733 million. 1.733 million coming off of this property, fully leased up at market rate. And that means that again, the cap rate on this fully leased is going to be probably sub 8, probably 7.5 cap, I would say. So if we look at that, so if we do, let's see, 10 cap, we're thinking on this one, $17 million. Let's see if what we would do maybe at 13. No, it's going to have to be more than that. So it's going to have to be, say, $25 million. And we're doing a 7.5 cap. Yeah. So that's exactly what it ends up being. So we're looking somewhere at the $25 million, which I would imagine that they go back on market and sell this. Once they have it leased up, they're going to sell it at a 7 or 8 cap. And they're looking somewhere, they bought it probably for, well, good question. I price per square foot in this area for a B or C class building, we're looking somewhere at the $250 to $350 a square foot for a class A sale trade. If you were there, they were to sell it, which I don't think they will. I think they'll just lease it out. But $350 a square foot times 135, 927, $47 million. So that's probably where it would trade today. It's bringing in what do we say? $13 more or less. Let's get proactive. 13 times 135,927. 1.7 million dollars. That's a tough purchase right there. I think that's probably pretty aggressive. I think we'd go maybe less, somewhere probably at the $35 million range. I know we just swung $10 million, but okay. Let's take a quick look here at what else is available in the area. Before we move through that too fast. Here, let's look at this one. I've sold a building out here, Kimbo Road. Pretty cool looking development. We've got a bunch of pad sites, one acre pad sites. Basically, this guy buys a flag lot. He comes in here. He's got frontage of, looks like they're going to hold on to this front one here. What a surprise. Let's look at the Kimbo Road Center. So let's take a look at this one. You got 25,000 square feet of rentable. Looks like they're going to. So they're just going to sell off the lots, and they're offering to build probably this front space right here, looking to build the 25,000 square feet. So you can see here they're doing 10,000 to 100,000 standalone buildings. Then we got the yard. Let's see if we can do an analysis on this one. So what we do is run through and let's see here. Let's pull this one and let's see if you guys can see a market report. Actually, better to do this. Let's go back and let's do an analysis of the 9 properties. Let's pull off a bunch of these. Let's do this. Let's take off all these other land ones. These are speculation. These are not. I don't like these. Yeah, great. You're trying to sell 15 to 20,000 square foot proposed buildings. So again, proposed. So there is no buildings here yet, folks. 2024, 2025, you're going to see a lot of buildings in Maynard, but let's just, for the sake of this demonstration, let's just pull into this here. So let's go to the analytics. So these are for the 2 proposed buildings. These are, they're not going to give us anything because it doesn't exist yet. Bummer. Okay, so go back to the map here. So yeah, just again, this guy is just subdividing out, or not subdividing, but he's creating a bunch of lots here, and then he's going to allow people to build. He'll do it. He'll build spec, or he'll allow you to do it. It's a detention pond. So this area up here is a detention pond. Seems kind of crazy. I mean, maybe the civil engineer made him do that, but having your detention pond on the front of your property versus off of the road seems a little bit crazy to me. Okay. Let's see here. What else we got going? All right. Facebook Live is going well. Cool. Okay. So let's do a quick few questions here. So how do you navigate the how do investors navigate the dynamic commercial real estate experience or market in Austin? I really think it's important to do a financial analysis first, then go see the property, walk the property, and then put in an offer. So at this point, I see a lot of people sitting on the sidelines. They're not really sure what's going to happen with interest rates. Look, no one really knows, but I do know that taking no action is worse than taking action when you take that action that is extremely conservative. And by that, I mean, put in a lowball offer. If you're worried about embarrassing yourself or embarrassing your agent, that's irrelevant. That's what our job is to help you make that transaction feasible on your side. Make it pencil on your side. I know what the seller wants. I hear that. I mean, we just saw what the seller wants in a lot of these cases. What the seller wants and the seller gets are two different things. And I say that as a listing broker. I'm going to list the price at the data supported best price possible when I list the property. If markets change, my offer or my listing price should change, but in a lot of cases it doesn't. So my advice to you as an investor is make an offer. At least start the negotiation. And I'm not talking about an LOI. I'm not going to say that's BS, but I take that with a grain of salt. Unless I really know that they're really interested and they're really just testing the price, letter of intent means relatively nothing. And it's not specific enough for me to be able to tell my client, the client listing the property, what exactly it is that they're offering. All it is a number and a hypothetical. So I understand it's kind of a pain in the ass to write them, but write an offer. An offer is executable. An offer shows that your client's really ready. The other thing is that it's actually your client writing it. Anybody can write a letter of intent. Somebody who's willing to take a positive action, move forward, and risk something, that's when we start talking about in a contract. So that's how you should navigate the financial and commercial real estate market in Austin. Number one thing to do, if you want to know what your property is worth, if you want to know what a property is worth that you're looking at buying, ask a broker for a broker's opinion of value. I write them all day, every day, no problem. I have all the information here. It takes me no time to do it. Happy to do it. Happy to tell you exactly what your property is worth today in today's market, what it would cost to sell it, who the buyers would be, what the proposed use would be, whether you should sell it today or not. I mean, I don't think that you should always sell every property. I just told a client last night he should hold on to all of his land. I don't think it's a good idea to sell land right now. I will recommend that if you have a cash flowing property that and it's passive income, a triple net lease that we've been looking at today, fantastic time to sell. Buyers are looking to buy cash flowing properties because they want to hedge their bet against inflation. They want to put their money somewhere where that's tangible. They are pulling it out of Bitcoin. They're pulling it out of the stock market. They're pulling it out of the bond market. Nobody really knows where those things are going, but make sure they get a good price for whatever you're purchasing. And by that, I mean, what is the future intended use of the property? If the future intended use of the property is to buy and hold it in a agriculture play, for example, so you put some cows on it, you save on your taxes, you park money somewhere for a while, great. Build that into your model. Just realize that when in a land appreciation game or a land hold, you're banking on appreciation. So that's not a great investment strategy for a lot of people. They want to see their money grow and have a more predictable income stream. You're not really going to do that off of the corn farmer or whatever you're leasing that, or the rancher you're leasing that property out to. So just go into an investment knowing what you're trying to do, what you're trying to accomplish. Next thing is, if you're interested in what your property would sell for today, it is just purely a function of what it's being used for today and what your new buyer might be using it for. So, for example, if you already have a tenant in there and the tenant has a lease for the next 10 years, and there's no buyout clause, there's no alternatives, your proposed buyer knows exactly what they're going to be receiving for that property in a lot of cases, right? I mean, there's things, vacancies happen, down economy happens, client asks for a lease renegotiation, a lot of things. But in most cases, you're going to be collecting that income for the next 10 years. And so be careful when you create a lease. That is a lasting thing. It's like the two things I think about is the restrictions that you would put on land. Those carry with the property forever until they're nullified. And that nullification is super hard. So if you are really opposed to something happening on your land, even after you're gone, even after you sell it, then yeah, by all means, create deed restrictions. But I always think about this, like, you don't really know what the land is going to be used for in X number of years. And if you put a deed restriction on this now and you just say no mobile home communities, for example, And then in 5 years, you get a great offer from a mobile home community. You're like, oh man, I shouldn't have done that. Or you sell it to somebody and they're like, all I want to do is put a mobile home community on there. They're going to see a deed restriction. They're going to say, nope, don't want to buy this anymore. So really important to think about that long term. So Austin presents a wealth of opportunities across different sectors. In healthcare, there's a growing demand for medical offices, dental offices, and specialized healthcare facilities. I go long on healthcare right now because we have an aging population. They have money. They Medicare, Medicaid, insurance will subsidize a lot of it, and doctors often would like to own their own building. It's a good investment for them. It diversifies them away from the stock market, bond market. They actually can work on it changes the expense for them from a capex to an opex, so they can start leasing their own building to themselves, which is pretty cool. So they're gaining in the appreciation of the asset. They're also gaining in the income coming in from their business paying them, and they can decide to bring in other tenants that would be paying them an income as well. So for all those reasons above, I'm very pro medical office. There is not a abundance of it in the Austin area. I've got 2 or 3 for sale right now, and I'd be happy to tell you more about those if you want. My advice to you is, if you would like to buy or sell a building, get a broker's opinion of value. If you own the building, you own land, any of my clients can tell you that I'm more than happy to write a BOV, broker's opinion of value, in complete thorough detail, completely free, a no obligation free value proposal, as my friend Dan says. But I'd be happy to do that. I've got all the information available. I've got all the data and metrics, and I base all of my pricing and all of my offers on data. And I put a heavier beta on closed transactions versus listed prices. Again, bid-ask spread is getting bigger right now. And I anticipate that reverses here in the next 2 quarters, and we start to see a right sizing of the market, let's say. If you have any questions, please reach out. I really appreciate each and every one of you. Thank you very much. And until next time.